can almost refer to it as a perfect storm. We had pressures from all different angles on the industry. One of it obviously is the input cost, where your grains or the corn or maize and soya beans make up about 85% of your feeding cost, and feeding cost approximately 70% of your total cost. So we had enormous pressure there, maize up year on year above 40%. And then our inability to recover that in the market. And two things from the demand side, it was impacted upon by high levels of imports. This time around, a bit of significant change that the imports are now coming from Europe and not most of it from Brazil anymore. And that's purely because of liberal trade barriers we have between South Africa and Europe. And then on the other side, the consumer is under pressure. We know what happens in this country currently. For the first time reported unemployment above 25% level. And then the impact that all the labor unrest and no work, no pay currently have on the consumer market also impacts negatively on our market. So all in all, a lot of pressure from macroeconomical factors and then some local influences that put us in an enormous margin squeeze.
Looking at the state or the health of the South African consumer, that obviously has quite an impact on your pricing power, and yet you've been able to, within that poultry division, see higher volumes and pricing levels improving by 5.6%. Just how easy is it to see price improvements through and push them through to the South African consumer?
Yeah, it's not easy. Poultry is by far the cheapest source of protein, and it's farmed on a commercial basis. So your decision making in that process to tune to market conditions almost take you 2 years. So you don't have the adaptability to match with the market in the short term. However, we did manage realizations up 5.6%, but by far not enough to recover the feed input costs that were up 24%. So tough market conditions.
And we see that illustrated by the fact that your profit margins are down 5.8%.
Yes, profit margins are down. Purely again, our inability to recover the higher input cost. So the market did not allow us, because we produce slightly more chicken in this country and imports is up. So the imbalance of supply and demand obviously driven by the state of the consumer, impacted negatively on our ability.
Chris, quite a bit of distinction though needs to be made between the two divisions that make up Astral, that being poultry and then your feed. I mean, we saw the lower profitability come through within the poultry division, but then we had profitability improve in the feed segment of the business. So to what extent does the one offset the other?
Yeah, feed has got the luxury of selling about 51% of their volumes internally. So there's an arm's length agreement on pricing and margin between the two divisions, and they can pass on inflationary cost and the raw material cost. It is then up to poultry to go and recover it out there in the open consumer market. So feed has got that luxury, and it's also slightly more segmented into other disciplines like dairy, like the swine industry. So feed in a slightly better position to recover inflationary costs than poultry.
And that influencing your operational efficiencies, in a very big way. Run us through the kind of operational efficiencies you've had to now take charge of.
Yeah, on the biggest impact on your production efficiencies is your ability to convert feed into meat. So obviously you want to have that ratio as low as possible. Currently, we're just below the 1.7 kilo ratio, so we need 1.7 kilo of feed to produce a kilo of meat. So you want that ratio to be as low as possible because of the impact of the high raw material cost now. But our efficiencies is actually done well for us, and the profit in the poultry division could have been much worse if it wasn't for the new genetics that we have installed in our business over the past 2 years. So our conversion rate is continuing to improve year on year.
Yeah. Run us through your Africa strategy as it stands right now, because you are expanding on that front, but we know in the past we've had a conversation about that expansion being less aggressive than you would like it to be, given the African consumer that's out there, and that's simply because of infrastructure challenges that present themselves?
You're on the money there, Alishia. Our other African operations is giving us the luxury that per capita consumption of poultry is very low, so it posed a nice opportunity. However, the infrastructure is not the same as in South Africa, and we don't have the silo complexes and the infrastructure that we have here with regard to electricity and water. So we can be much less aggressive there. So our investment in those countries are on the up, but it is still much slower than what you could do if you had the perfect infrastructure. So if you venture into a new country and there is not a SAFEX trading board, how do you buy your maize? You buy it from a farmer in a wheelbarrow. And those are the kind of things that restrict you from quicker expansion.
Outlook for the year ahead, Chris?
Unfortunately, not good news. One of the key drivers for the outlook is how the grain balance sheet around the globe will change. And unfortunately, we had a very bad season in the United States of America, where yields were way down about 25% because of the worst drought in 50 years. So this stock-to-use ratio for grains around the globe are extremely thin, and we need a good rain season and a good crop and yield, both in South Africa and in America, before we will have some relief from the feed input side. And then on the other side, the demand, the consumer, will it change? We believe this festive season won't be that great because people are not going to earn bonuses, and then the whole mining industry currently under fire, and I don't think we're going to have the discretionary disposable income that we've seen over a normalized December.